Hi, Mike Swanson of Wall Street Window here. It's good to see you. Like this video so that I know you're there. And if you're watching the recording, like it too, because it's always good to give feedback. Now, I want to talk about three things today. I want to talk about a book that's came out a couple months ago by Edward Thorp, Man for All Markets, and something in it that's influenced my thinking. I'm going to talk about an individual stock that I'm involved in that you might be interested in that's on the move. And the question, should you own ETFs, exchange traded funds, or individual stocks? Now, I own both in various accounts I have, and I want to tell you why I do one or the other. Now, there's been a virtual mania in exchange traded funds. There's really no other way to describe it over the past year, with money flowing into them like crazy at record levels in the first quarter of this year. And people have gotten into them, I think, as a panacea because it seems so easy to press a button and move a lot of money into them. And some of these funds, and particularly the 3 times ETF funds that are leveraged, can move so much up or down that people are kind of addicted to trading them for the pure price action. Now, I did an earlier video back in March saying that there's hidden costs to ETFs that people really don't think about very much at all. Now, ETFs are called they're passive investing instruments because they simply own a basket of stocks, and most of them don't try to pick the stocks or manage them. They typically will track something like the S&P 500, which the SPY does. Now, most mutual fund managers fail to beat the market, and so it's been a popular notion that forget mutual funds and just buy SPY as an alternative because the fees are lower, and therefore you'll beat most money managers. And that's all true, but a lot of these exchange traded funds are not as diversified as people think they are. And something in this book I'm going to show you that has made me realize that actually, as investments, in the long run, individual stocks are better because you're going to make more money from the dividends when you own individual stocks than you do just simply plunking all your money into exchange traded fund. And you also don't pay any of the management fees at all that the exchange traded funds charge. So, for instance, the GDX ETF charges about 0.5% management fee every single year and pays a fraction of a dividend of like 0.25%. Well, in my main large account, instead of owning GDX, which is the gold stock ETF, I'm owning gold stocks outright. I've picked out 15 gold stocks, and I'm getting much bigger dividends. These are big cap gold stocks that are safe, that GDX owns them anyway. And I believe this sector is a great investment, and I'm just holding them for the long run and getting the bigger dividends. Now, however, there's a time when it might be better to buy an ETF than invest in a basket of stocks instead, and that's if you have a small amount of money. Because if you buy, let's say, 15 stocks and you pay $10 commissions for each stock, well, that's $150. That might amount to a lot of money. If you only have $10,000 in an account and you want to invest, you're probably better off avoiding those fees because $150 actually does add up and is more than 0.5%. So I think the amount of money that you have really is the defining factor as far as investing goes, and whether you should buy ETFs or individual stocks. So if you got 50,000 or 100,000, actually, I think you're better off investing in individual stocks. Now, if you're trying to short or time the market with a time frame of a couple months, which I do sometimes, then ETFs might be the better. So that's one way I think about this. And if you're investing in something like commodities, there's commodity ETFs, which there aren't really that are better than trying to buy individual commodities. And gold, if you want to buy physical gold, you're going to have to go with a fund and so forth. But let me talk about this book because it relates directly to this topic. Then I'll show you an individual stock. Now, Edward Thorp is a pioneer in quantitative analysis when it comes to financial markets. That means using math to figure out the optimal things to invest in, or how to invest, how to manage money. And he pioneered this field. He's the guy, if you don't know, who also invented the notion of counting cards at blackjack. He wrote the book Beat the Dealer back in the late 50s or early 60s. And this book is like his memoirs. He talks about his life and, you know, the interesting stories about counting cards and the casinos and so forth. But he also managed money and was one of the most successful money managers. But so he came out with this book. In chapter 25 is very interesting because it's titled "Beat Most Investors by Indexing," and again he talks about the idea of forget about the mutual funds, just buy the passive fund, which is today the ETF. But he goes beyond that with a deeper level in thinking, and I want to share with you some of his thoughts. First, in this chapter, he talks about Bill Sharpe, who invented the Sharpe ratio, and he notes that if you combine all the holdings of all the active investors in the financial markets, it's mathematically going to replicate the S&P 500. Now, this idea is well known. You've probably heard of this before, but few people really think about the ramifications of this and how it might apply to their own thinking. Again, to repeat, if you just take the holdings of everyone in the stock market in aggregate, it's going to basically duplicate the S&P 500. Now, what that means is individual returns are pretty much statistically distributed together, and this is why passive investing works in beating ownership in a mutual fund. In other words, you're better off buying SPY than the average mutual fund, because the mutual fund is going to charge you 1 or 2% fees, where SPY is going to charge you a fraction. Now, here's what got my attention. The S&P 500 basically is made up 500 stocks, which are 75% of the market cap of all publicly traded stocks, amidst just a couple of the big 10 companies. That's why it tends to match the overall stock market returns. But here's something to think about. The Dow 30 is 30 stocks. And interestingly enough, even though it's only 30 stocks, it typically every single day is matching the performance of the S&P 500. 30 stocks are matching the performance basically of 500 stocks. Well, that got me to thinking, why buy SPY? Why do you have to be owning 500 stocks or 100 stocks to be diversified if 30 stocks in the Dow are going to replicate the SPY? Well, that same concept goes for sector investing. Why own GDX and pay that 0.5% a year in fees in that sector if you want to invest in mining stocks? So we could say the same thing about oil stocks. Why buy the XLE ETF if you want to invest in oil stocks? So you can just buy 30 of the big cap oil stocks. You're going to get the same basic results as XLE and not pay the management fee and get higher dividends. Well, here's what this guy studied. If you apply that Sharpe's principle, and if you choose 30 stocks at random in the S&P 500, guess what's going to happen? You're going to just about match the S&P 500's return. If you do 1,000 studies picking out 30 random stocks, you're going to match the return of the S&P 500 if you pick 30 stocks in it at random. This has huge ramifications, because what that means is picking out individual stocks. If you're an investor and you have a sizable amount of money and the commissions don't matter when you buy, you're going to beat the market pretty much, because you're going to avoid that management fee even though it's small. The thing is, people are easily intimidated with the idea of picking out stocks, and they think, well, I'm just going to buy the ETF so I don't have to pick any stocks out. I can just be super lazy. But if picking out 30 stocks at random is going to match the performance of the S&P 500, 30 stocks at random in the S&P 500, then you don't have to be intimidated about which stocks to pick. Now, here's the disadvantage in buying individual stocks. The real disadvantage, the true disadvantage isn't picking out the wrong stocks, but this, which I'm going to quote what he writes here. The main disadvantage to buy and hold versus indexing, let's say buy and hold individual stocks versus indexing and buying and holding the ETF, is the added risk. But the real risk is this. In gambling terms, the return to buy and hold is like that for buying the index. However, with a holding of 20 or so stocks spread out over different industries, this extra risk tends to be very small. The threat to buy and hold is the investor himself. Following his stocks and listening to stories and advice about the individual stocks can lead to trading activity, producing on average the inferior results about which I've warned. Simply buying the index or the ETF avoids the trap. What's the trap? Again, I'll repeat. If you own, let's say, a random 30 stocks in the S&P 500, you're going to pretty much match the performance of the S&P 500 over time. The risk, though, is that you'll watch these stocks, you'll read the news about them, and get scared out of them and start over trading. And that over trading will cause you to make mistakes. But if you realize that I don't need to worry so much, those mistakes won't happen. Think about the Dow. If on January the 1st you bought each one of the Dow 30 stocks with the same amount of money and turned off your computer, turned off the television, ignored the financial media, and came and looked at your account on December 31st, what would happen is you would match the return of the Dow. However, if you watch these stocks, and got shaken out of some of them, you probably would end up lagging the return of the Dow 30. And that's despite the fact that some stocks in every given year are going to do bad in the Dow. Even in the most bullish of markets, and some will outperform. But if you just bought all 30 stocks and come back on December 31st, a year later, that doesn't make any difference if some lag and some outperform. It all is just going to kind of even out over time. The ramifications for this when it comes to investing in an individual sector such as gold stocks, and if you got other pet sectors, just think about them. But gold stocks are what I'm focused on right now, and I'll show you a gold stock in a second that I actually do own. But the ramifications are clear. If on this moment you bought 15 gold stocks instead of buying GDX, at the end of the year, I'm talking about big cap gold stocks paying a dividend. If you do this, and at the end of the year, you're pretty much going to match the performance of GDX. However, you'll probably actually beat it because you're not going to be paying the management fee, and you're going to be getting better dividends. And you also do much better than GDXJ because it's got problems with it that's impacting it in a negative manner. It's malfunctioning is the best way to put it. It's not performing up to the promises that people are expecting. They're having to do rebalancing, and it's just becoming a mess. It's also impacting, of course, JNUG, the 3 times long ETF, which these two ETFs are now becoming toxic disasters, while the people that are buying mining stocks are doing well. As I'm speaking, JNUG is near its December lows, while many big cap mining stocks, such as Franco-Nevada, Royal Gold, and Eagle are breaking out. Newmont is on the verge of breaking out. Yes, I do own all these stocks mentioned, while JNUG holders are suffering very badly. This is to show you that if you buy ETFs, if you buy the wrong ETF, a malfunctioning ETF, you're going to suffer. So avoid GDXJ and JNUG totally. If you want to buy an ETF in the mining stock sector, buy GDX. Now, I believe individual mining stocks are huge. They're the way to go. And they're better than buying the ETF unless you only have a small amount of money, like $5,000 or $10,000. If you can't afford to put $1,000 in 15 stocks, then just buy GDX. Now, I did. So I'm just trying to, tell you how fascinating this study is. If you're investing in a sector, if you buy a mix of big cap stocks, you're going to match the performance of the sector. And that means you don't need to use these ETFs and pay the management fees. Now, let me show you a mining stock that I own right now that actually makes the point of owning mining stocks or owning individual stocks instead of an ETF even better. Okay, now this is GDX. Now I do own GDX. I'm not saying never own an ETF. I own GDX in an account that's smaller than my main account because I really can't afford to buy 15, 20 stocks in this small account. But my main account, I own individual stocks instead of GDX. But look at GDX today. It's up 4.85%. It's up $1.10. I've talked about the GDX divided by GLD ratio, and we could be on the verge of breaking out. When that happens, I'm expecting GDX to rally up to $30 over the next over a space of a quarter or two. Once the ratio breaks out, I'm not trying to predict the breakout happening tomorrow, but we're probably touching it now. But anyway, I'm getting ahead of myself. Here's GDX. I'm going to show you an individual mining stock I own. Now, OR surged yesterday to be one of the top gaining stocks in the entire stock market. Now, I bought it before that surge, and it's up today 2%. But it's up over 12%, I think, in the past 3 days. Massive gains, massive returns, and that's helping my own account that's invested in mining stocks. If I just look at that aggregate there, it's been wonderful because this one stock has pushed up so much. And that's the beauty of, picking out individual stocks instead of simply dumping your money into an ETF to be lazy. If you pick out individual stocks, you can get ones paying bigger dividends than the ETF. You can pick ones out that got better earnings growth than the sector as a whole. You can pick out, if you want to invest in a sector, whether it's bank stocks, whether it's oil stocks, whether it's mining stocks, you can pick out 15 stocks in that sector. It doesn't take much time to find ones paying higher dividends in the ETF that's got the highest earning growth of the sector. Invest in the best of the best. And you can do that, and you should be able to outperform the ETF. You're going to at least get bigger dividends. And in aggregate, your 15 is going to probably match, but the bigger dividends and lower fees will help you outperform. And now it's a different story if you're a manic day trader trying to jump out every 48 hours, or you're addicted to JNUG and DUST and 3 times ETFs just because you like to see gyrations in your account. And that's a tough game. It's very difficult to trade 3 times ETFs and expect to beat the overall sector because the movement of those ETFs are so crazy. And not only that, they have decay factors that over time you've got to overcome. And the decay factors for JNUG and DUST has meant that over the past 5 years, both of them have gone down over 80%. Both of them are total disasters for anyone trying to buy and hold. And you've got to overcome that decay. And some people will say, oh, I only hold for a couple of days. Well, the decay is still happening day after day after day. That's why you got to stay out of JNUG and DUST and other 3 times ETFs. If you're trading bank stocks, avoid the 3 times ETFs. If you're trading oil stocks, don't buy the 3 times ETFs. If you're trading the S&P 500, don't buy the 3 times ETFs. Don't do this. Don't be crazy because don't try to overcome that crazy decay. Be safe and prudent and start to think about, I'm going to escape management fees. I'm going to escape decay fees. And because these things all add up over time. And I'm going to end with a very simple story. I used to play poker a lot and go, I just don't travel as much as I used to, but I used to go to casinos and play poker. And one time I went to a poker table at, let's say, 9 in the morning and sat down with $500, and it was a no limit poker game. one, two, no limit. And I played for 10 hours. And what I saw over this period of time was 5 of us were at this table the whole day playing together. And people would come to this table and sit down and lose their money, and someone new would then come and take their place. That person will lose their money. Someone new would come and take their place. And the 5 of us, though, stayed there all day. What that meant was we were taking these people's money. And they were, the people, the losers, were sitting down and giving us their money. And that's sort of, in a certain sense, what happens in the financial markets. But this is what happened. At the end of the 10 hours, I walked away with that table with a very tiny profit, very small. And I watched the other people's stack of chips. They didn't go up that much either. We did not make nearly as much money as the people who sat down and lost. Why? Why'd that happen? Because on every hand at that card table, the casino was raking the pot, about 10% on average per hand. And that adds up, hand after hand after hand after hand. And that's why the casinos make they pretty much are guaranteed to, they make money on every hand in the poker room. And if you play 1, 2, no limit poker, it's very difficult to come out ahead of that rake. It's called a rake, the amount of money the casino takes. Well, the same thing happens in the stock market, and that rake is bigger. It can be a different size depending on what you're doing. If you are buying 3 times ETFs, trading them, or trying to hold them, that rake is enormous. And that's why these ETFs just go down and down and down in value, because over time, because of the decay factors. And if you are buying ETFs, if you're buying mutual funds to hold, you're getting raked 1 to 2% a year. If you buy ETFs, if it's GDX, you're getting a 0.5% rake a year. If you're buying SPY, it's like 0.2%. But over years, that adds up. A 0.5% is 5% over 10 years. Over 20 years, that's 10%. That's money, when going out of your account, vanishing to the world of Wall Street. If you buy and own individual stocks, you are only charged a small commission one time, as long as you don't, do any more transactions. So that's why over time, investing in individual stocks is going to beat all these transaction costs you get from so-called passive investing, as long as you don't make mistakes by owning these stocks and getting scared when one drops or bad news hits, and have the mentality that, okay, here's a sector I like, boom, I'm buying these 15 stocks, these are investments, I'll make some changes. If I don't like this sector, I think it's time to rebalance my portfolio, then I'll make changes, all in the mind of money management, not simply reacting to daily price gyrations or noise, which is basically what most of the news is. And if you buy individual stocks, then you can wake up on those mornings and see, like I just did yesterday, one of my stocks surging up sky high, while on that day, GDX is only up a little bit. My account was up more, or the portion of my account that's in gold stocks was up more, because I was in a stock that was wonderful. Now, there's also a whole other world when it comes to mining stocks, and that's the junior mining sector, where you can buy into private placements and get warrants, and these stocks go up, the right ones can double, go up like crazy, and then you got the warrants that help you add on to the gains. When you have things like that are out there as opportunities, it once again makes absolutely no sense at all to be someone that's buying JNUG or DUST or these 3 times ETFs. They're the worst possible way to get involved in the mining stock sector. Don't do it. And if you're in another sector, don't do it. I know I'm repeating myself, but I just wanted to emphasize that point, because it's so critical to avoid those toxic ETFs, because not only are they tough, but when you buy them, you're doing something else when you could be doing something else better. And it's these better things that you need to focus on. and not, the 3 times ETFs or they cause people so much stress and distraction that they miss out on better things that they can be doing with their money. And that's what you always got to be looking at when it comes to the stock market, learning, seeing what is the best thing I can do with my money, because there's new instruments, new opportunities that appear over time. ETFs are relatively new. 10 years ago, there was no GDX ETF. Now there is. And I've been trading and buying it over years. I do have it, as I say now, at the time of making this video. But something new comes out and you use it and you learn, hey, it may not be the simplest, best thing I thought it was. Let me rethink things. And this book made me rethink individual stocks versus ETFs. And I think it's, it's a fun book to read. And that was when it comes to investing, that was one of the most interesting things. Now, next time I do a kind of just educational video like this, I'll probably talk about how many stocks should someone own to be diversified. Does it take 5 stocks to be diversified or 10 stocks? I certainly don't think anyone should put all their money in one stock. And that's why if you only have $5,000 or $10,000, yeah, you probably should not be buying stock because you can't really buy enough to be diversified. In that case, the ETF is better. You're better off paying $50 a year. Let's a 0.5% on 10,000 is $50. If you wanted to put all your money in SPY, or that'd be $20, I think. GDX is, if you put $10,000 in GDX, you'd be paying $50 a year. Well, that's. But if you bought 15 stocks and you pay $10 per share per commission, that's now $150. So yeah, $10,000. The ETFs are probably better and cheaper than individual stock ownership. But if you're putting in 50,000 into a sector, or 100,000 into a sector, or hundreds of thousands into a sector, that with that kind of money, it pays to do additional work and not be lazy. If you're putting big money into a sector, it's a lot of money. You think about $50,000, how much work goes in to make $50,000, and you're just going to press a button and spit it all out into an ETF thinking you don't need to think. Well, that's really, I think, being super lazy when you work so hard to make tens of thousands of dollars and just press a button. You should spend a couple hours or a week or be willing to do the work to research the investments that you're going to put that amount of money into. And that's, I think that's one of the big traps of ETFs is they actually create this illusion that you don't need to think or do any work. You just be so-called passive investing. Well, such passive investing, I think, leads eventually to mistakes. Well, I've talked enough today. Like this video, send you more. Hit subscribe to my YouTube channel, and you'll get alerted as soon as new videos like this are sent out. This one's being done live. It notifies everyone on YouTube that's subscribed to my channel. Hey, this is live. If you're watching the recording and want to watch the next one live, subscribe to the channel, and let's see what happens with gold and mining stocks over the next couple of days and next week after the Fed meeting. I think it's going to be an interesting month we got ahead of us.